Have you ever wondered what would happen to your money if your bank failed? Most people think they're safe, that the government and FDIC insurance have their backs. But what if I told you there's a hidden power baked into modern financial law that could wipe out your savings overnight? It's not a conspiracy theory. It's a legal mechanism called bail-in authority, and almost nobody is talking about it. This power allows governments to seize your bank deposits during a crisis. Let me be crystal clear about what that means. It doesn't mean you get cash back. It doesn't mean FDIC insurance kicks in right away to make you whole. It means your hard-earned money, the cash you thought was safe in your account, can be legally and forcibly converted into shares of the very bank that is collapsing. You become a shareholder in a sinking ship, with no say in the matter. Think this sounds far-fetched, like something out of a dystopian movie. It's already happened. Let's take a trip back to 2013, to the small island nation of Cyprus. The country was in the grips of a severe banking crisis. One morning, depositors woke up to a nightmare. The government had enacted a bail-in. People with more than 100,000 euros in the bank lost nearly half of their savings. Just like that, gone. Their money was converted into bank shares that, predictably, became almost worthless. Families, businesses, retirees, their financial security vanished in an instant. Now, I know what you're probably thinking. That's Cyprus. This could never happen here. In the United States, we have the FDIC. We all grow up hearing about FDIC protection, that sticker on the bank door that promises our money is safe up to $250,000. And it's true, the FDIC is there. It holds only a tiny fraction. The rescue resources are quickly overwhelmed. A single bank failure, the FDIC can handle it. But a systemic crisis, where multiple banks fail at the same time, the fund would be depleted in a heartbeat. And that's exactly the kind of environment where bail-ins become not just possible, but probable. So, what could trigger such a widespread crisis? Look no further than commercial real estate. Right now, as we speak, there are over 180 regional banks in the U.S. that are heavily exposed to this ticking time bomb. A few years ago, when interest rates were near zero and property values were sky high, these banks handed out massive loans for office buildings, shopping malls, and apartment complexes. But the world has changed. Remote work has emptied out office towers. Online shopping has shuttered malls. And now, with higher interest rates, the value of these commercial properties has plummeted. Those loans that were made based on inflated values are now coming due. The property owners can't refinance, and the income from their buildings isn't enough to cover the debt. Defaults are not just a possibility, they are an inevitability. When these loans go bad, banks have to write them off as losses. If those losses become greater than the bank's capital, its own safety cushion, the bank becomes insolvent. It's bankrupt. This is where the chain reaction starts. News of the bank's insolvency gets out. Depositors panic. Everyone rushes to pull their money out at the same time, a classic bank run. But a bank doesn't keep all of its deposits in a vault. It's loaned out. The liquidity, the available cash, disappears in a matter of days, maybe even hours. At this point, regulators have to step in to prevent the entire financial system from collapsing like a house of cards. In the past, the solution was a bailout. Remember 2008. The government used taxpayer money to prop up the failing banks. Well, governments learned their lesson, but not the one you think. They didn't just decide to regulate banks better. They created a new tool, a much quieter and more insidious one, the bail-in, thanks to laws like the Dodd-Frank Act here in the U.S. regulators no longer need to use taxpayer money. Instead, they can use your money. The depositor's money. Here's how it works legally. Any amount you have in a bank account over the insured limit, that's $250,000, is treated as an unsecured loan to the bank. You are technically a creditor, and when the bank fails, you are one of the last in line to get paid. The bail-in authority allows regulators to take those unsecured loans, your deposits, and convert them into equity or stock in the failing bank. This happens without your consent. You have no choice, and it gets worse. The moment a bail-in is triggered, trading in that bank's stock is immediately halted. You can't sell the new shares you were just forced to own. You can't cut your losses and run. You are trapped, forced to watch as the value of the bank and your converted savings continues to plummet towards zero. Your life savings, your retirement nest egg, the money you set aside for your kids' education, can evaporate in a matter of weeks. Who does this system really hurt? It's not the billionaires and the megacorporations. They're smart. They don't keep millions of dollars sitting in a simple checking account. Their wealth is diversified across treasury bonds, sophisticated trusts, and other financial instruments, spread out to minimize risk. The real victims of a bail-in are the backbone of the economy. Small business owners who need to maintain large payroll accounts. Retirees who have consolidated their life savings into a single bank. Families who have money in an escrow account to buy a home. Everyday people, the middle class, who have accounts that exceed the insurance limits simply because of a lifetime of hard work and saving. These are the people who will be blindsided. The legal framework for this is already in place. The financial stress is building every single day. The losses in commercial real estate are accelerating as more and more of these loans come due. This isn't a question of if, but when. When the next wave of bank failures begins, bail-ins won't be a topic for debate on the news. They will be executed swiftly and decisively by regulators doing what the law empowers them to do. The system is designed to save the banks, not the depositors. It's a harsh truth, but one we all need to understand. The only question left is, will you be prepared, or will you be one of the ones forced to pay the price? It's crucial to understand these risks and think about how your assets are protected. Thanks for watching. If you found this information valuable, please consider liking this video and subscribing to the channel for more content that looks behind the curtain of the financial world. Stay informed and stay safe.